Welcome back. Module 8, Golden Rule of Investing. So, you have seen what is fundamental analysis, within fundamental analysis, macro analysis, then micro analysis, qualitative, and micro analysis, quantitative. We have seen extensively the numbers and other things. With all these things, okay, how to go about doing an investing. Golden rule of investing, that is what we call in module 8. Then in module 9 we will cover technical analysis. Module 8 is golden rule of investing. So again, our target audience is the same, so I am just not going to repeat it, I am just showing here. Takeaways: simple steps to identify good business, golden rule of long term investing, be a successful long term investor. Please understand the word investor, okay. So, golden rule of investing. So, simple, what you do is that list top 50 or 100 stocks of Nifty stocks. So, if you are new to investing, again I told you, if you are a small investor, you do not have time, you do not have anything, please go to mutual funds. But having said that, you have interest and passion, please follow a systematic and structural way of investing. List down the top 50 or 100 stocks, because that is easy to identify and analyze. It is, and take the easy to understand business like automobiles or mobile or IT or any industry that is easy to understand. Let us say PI chemicals or these kind of industry, those technical jargons are very difficult for a common man like me to understand. Okay. Suppose if somebody is from the chemistry background or they can understand, that is fine. But normally, generally I find people are not that comfortable with chemistry. So, where you do not know about that industry, it is better avoid that. Identify the following: future business potential, challenges current and future. What are the current challenges and future challenges? What are the growth opportunities for the next 1 to 3 years for the industry, for the company? Okay. So, all these things you identify. Then identify business that are resilient to economic climate. So, classic case is let us say for example white goods. So, in times of crisis we avoid that. Generally people who are in crisis or who are basic sustenance problems, or if they have little difficulty in running the family, they will defer or delay the buying of that white good items. Whereas a medical or a school, college or education related or a pharmacy or medical related items, people cannot defer. So, somehow even if they borrow, they will spend that item. So, identify as an investor, identify that businesses that are resilient to economic climates. That is very important. Avoid cyclicals or cyclicals during bad economic conditions, because in bad economic conditions cyclicals are the worst performers. When the economy is in trouble, classic impact will be on automobiles, okay, two-wheelers, car sales will come down. Hence, no, cyclicals are something, when the economy is doing, overall economy is good, they will tend to do well. Okay. Then pricing power of business, which we have seen in Porter 5 forces, how well the company can has the pricing power over a period of time. How well, look at their products, look at their brands, how well they are pricing it. With increasing cost, are they able to pass on the prices? Still, are their sales is getting increased, or are the sales coming down? So these are some of the measures. Government policies impact. So many times government policies will play a significant impact on the pricing of the product. Sometime back during Corona time, government came and imposed regulations on the cap on the airline fares before Corona, and after Corona, what you call seats were not being able to full, because one seat, middle seat has to be left empty. That was government mandated rules. So hence now avoid industries or avoid companies where there is government policies or government intervention. So the classic thing is that Indian IT company grew because there was no government intervention. So hence, like, IT companies grew on their own, thanks to our IT, because IT is one of the major exporter of India, from India. So that's an important one. So look at those kind of industries or companies. Then foreign players import competition. So look at companies or industry where foreign players are coming or might come. So where the economy is open, today the entire economy is integrated. So certain industries, foreign players will not come, or they might not be interested to come in, or there will be some restrictions on foreign players in directly entering the market. So look at those opportunities, because foreign competition, it is very difficult to face a foreign competition, and that too Indian companies, if they are not investing in R&D. So hence that is very important. Dividend distribution policy. Look at the company's dividend distribution policy. Why? Because a company issuing bonus is, and on the other hand, another company, if they are issuing dividend, that means the company issuing dividend is without other, looking at the other parameters, is a better company. Why? Because dividend distribution involves cash distribution, cash flow management, how effectively they manage their free cash flows and total cash flows. That's important aspect of it. Whereas bonus is issue of additional shares, just a book entry into the depository. I'm not going into the details of other details, just on the top of it, if I were given two information like this, I would always choose a dividend distribution company as a better company than a company that is issuing bonus and not issuing dividends. Institution holding patterns, mutual funds, FIIs, what is their holding patterns, whether the holding is increasing or decreasing. If there is a steady increase, then you can understand that the big players are interested in a long-term association with the company. That means as a small investor, we can feel that we are safe, because the company is a sound company, good management. The big players are also having trust. Of course, there are cases where big players also failed miserably. Let's not go about the exception. Let us talk of the general things where big players have better ability, better capability, infrastructure to analyze about every companies, and if they have taken the decision and consistently increasing the holding patterns, then that means it reflects something good about, positive about the company. Increase or decrease about the promoter stake. So any increase or decrease in the promoter stakes will have a impact on the share price. So normally what happens, any decrease in promoters share is perceived as something negative. Okay, recently one company, I think the foreign promoter wanted to dilute the stake, then the company share price tanked by 10% or so in one day. So such things happen because market perceives that way, whether it could be for any reason. So hence, no, if a promoter or somebody is diluting their stake, it is perceived as negative, but not always it can be perceived as negative. Sometimes the promoters can sell for any philanthropic, or a small fraction they can sell for personal reasons also. However, if the promoter stake is increasing, it is a direct information or indication that the promoters have higher confidence on the company. That is why they are increasing their stake. That means as a small investor, one can be clear that no, if promoter stake is increasing, it's a fantastic company, and it is time for us also to enter the stock if you are not entered, or we can increase our stake. These are all signals. Okay, it's not, I'm not giving any specific company examples, these are all general examples. Corporate governance and ethical behavior. So this is something very, very important. Corporate governance, how good the company is in terms of governance, how well they manage their employees, how friendly they are to the environment, society, to the shareholders, to the employees, everyone, all the stakeholders. And trust on ESG. So environment, social and governance. As you know, today some funds, they come out exclusively on ESG funds. So hence, that is something important. So ethical behavior, ESG, and stocks that are generally technically, stocks that are above 200-day moving average, institutions tend to buy. So these are some of the golden rules of investing. Lastly, if we go to the next slide, golden rule of investing, slide 7. So very simple. Again I reiterate, if you are a small, I read what I have put here. If you are a small investor or investor who cannot take informed decision, what is informed decision? Getting all the information, analyzing the information, assessing the information, the pros and cons, the benefits and the negatives of that information, or you don't have time, lack of time or bandwidth to track and invest in companies. What is best? Mutual fund is the right fit for you. Don't be shying away from mutual fund, because on behalf of you, somebody is going to do the job while you can focus on your core business. That is the USP. You can focus on your USP. So these golden rules you follow, or finally follow this golden rule which I said. If you are a small investor or investor who doesn't have time or who cannot understand these financial jargons, please go to mutual funds. Thank you very much.